When we think of corporate bankruptcy, we imagine a massive legal apparatus designed to rescue complex, sprawling organizations from sudden collapse. We picture thousands of jobs saved and billion-dollar balance sheets reconstructed by teams of lawyers. The archetype in the American imagination is the mega bankruptcy. We think of airlines like United, energy giants like Enron, or retail empires like Kmart. The daily reality of the bankruptcy court docket looks entirely different. The typical corporate filer is a livery service, a local drywall contractor, or a corner restaurant operated by a single owner. There are roughly 10 to 15,000 Chapter 11 cases filed each year, and the overwhelming majority involve these micro-businesses. They have few employees, minimal revenue, and negligible physical property. Chapter 11 is an incredibly expensive, highly complex legal procedure designed to reorganize assets. For tiny businesses with virtually no assets, the high cost of entry seems to outweigh any potential corporate benefit. Small business bankruptcy functions as a labor market intervention. The law preserves the owner-operator's career path, rather than the corporate entity itself. The foundational justification for our bankruptcy system relies on an elegant, decades-old theory of corporate finance known as the creditor's bargain. It starts with a precise legal definition: insolvency. A firm is officially insolvent the moment its total liabilities exceed the total value of its assets. When insolvency hits, it triggers the common pool problem. Every lender wants to be paid out of the same dwindling pile of cash, setting off a race of diligence where each creditor rushes the court to seize whatever property they can grab first. If the law allows this race to happen, creditors will dismember the company. The bank takes the machines, the landlord takes the building, and the supplier takes the inventory. The rationale for stopping this dismemberment is going concern surplus. This concept traces back to 19th century railroads. A railroad might be in deep financial distress, unable to pay its massive debts, but it is not in economic distress. It still generates far more value operating as an integrated transit system than it would if creditors melted down the tracks for scrap iron. To protect that surplus, Chapter 11 provides a legal shield called the automatic stay. It halts the creditors immediately, freezing the race so the debtor can reorganize its debts while keeping the profitable operations intact. The logic is sound, but its entire architecture rests on a single assumption: that the failing business actually possesses a unique, integrated value worth preserving. In 2005, legal scholars Douglas Baird and Baird Morrison put that assumption to an empirical test, digging through the dockets of the Federal Bankruptcy Court for the Northern District of Illinois. They tracked every corporate Chapter 11 filed in that district in 1998, narrowing a list of 184 filings down to 104 owner-operated cases. They followed these specific businesses for years, pulling schedules, tax records, and conducting site visits. The demographics of the sample confirmed the micro-business reality. Over 80% of the debtors in these cases employed fewer than 20 people. They were also young enterprises. The median age for these businesses was roughly 7 years, meaning they had not been entrenched in the market for decades. Out of 104 filings, 65 cases, 62.5%, ultimately ended in the business shutting down or being dismissed. Tracking the remaining fraction reveals that only 14 original businesses actually managed to stay operating long-term. To understand why the failure rate is so high, we have to look at what these businesses actually owned when they filed, using an economic metric called asset specificity. Breaking down the balance sheet, if we strip away universally fungible real estate and then remove generic, easily auctioned equipment like computers and desks, specialized assets amount to just 2.2%. The integrated going concern value is mathematically absent. The researchers highlight a specific case to illustrate this missing asset problem: a plastics manufacturer called Nieman Industries. Nieman Industries ran an operation using large injection molding machines, but the company didn't own them. They were leased. The physical tools of the business were entirely replaceable. The only true specialized asset the company relied on was Scott Nieman himself. His personal knowledge of the plastics industry, his supplier relationships, and his operational expertise were the sole engines of value. Unlike a railroad's bolted tracks, Scott Nieman's human capital is highly portable. He can take his expertise elsewhere, leaving the failing corporate shell behind entirely. As the authors point out, it is no more desirable that Scott Nieman spent his life overseeing a failing manufacturing operation than it is that Yo-Yo Ma play the violin. Analysis should shift from the corporate entity to the individual owner-operator. The data supports this shift. Roughly 85% of the owner-operators in the Illinois sample were serial founders. They build, manage, and close multiple businesses throughout their careers. When the researchers tracked the individuals whose cases ended in shutdown or dismissal, they found that nearly 70% of them had simply moved on and started another business. The success of a reorganization system should be judged by how efficiently it manages and redeploys the individual's human capital, not by whether it preserves a doomed firm. When a corporation has no unique assets to protect, the decision to endure the high cost of Chapter 11 points to incentives that aren't visible on a balance sheet. Some operators use the court purely for tactical bargaining leverage. In one instance, a restaurant owner filed mid-trial to freeze litigation, forcing a favorable settlement before quickly dismissing the bankruptcy case. Others use the process to run a clean title auction. Chapter 11 allows a debtor to strip away complicated liens, making an otherwise unsellable business attractive to a new buyer. But the most critical systemic driver keeping these entrepreneurs tethered to the court system is an immense legal threat from the IRS, the trust fund tax liability. When a small business runs out of cash, the owner faces immediate pressure to make payroll. To survive a few extra weeks, they often dip into money they legally withheld from their employees' paychecks, money meant to be sent to the government. Under Section 6672 of the Internal Revenue Code, doing this triggers a massive penalty. And while this video is an educational analysis and not legal advice, the mechanics of this statute are clear. It pierces the corporate veil. The law converts what was a corporate tax debt into a strict personal liability for the entrepreneur. If the business fails, the owner's personal bank accounts and future earnings are on the hook, and this debt cannot be discharged in a standard personal bankruptcy. The entrepreneur files Chapter 11 to use the dying firm's remaining cash flow as a shield to pay off their personal tax debt. Because of these incentives, Chapter 11 for small businesses functions structurally like rent control. Like a tenant staying in a rent-controlled apartment to keep the subsidy, an entrepreneur stays with a failing corporation to keep legal protections. This is the lock-in effect. The law conditions financial benefits on the individual staying attached to the dying entity. This trap is systemic. Baird and Morrison found evidence of lock-in behavior in nearly 50% of all the cases they studied, and in 77% of the cases that eventually shut down. The cost of this delay is paid by creditors at the bottom of the legal hierarchy. General unsecured creditors see their recoveries flatline at roughly 3 cents on the dollar for cases under $200,000, effectively subsidizing the lock-in. When the business model is broken, delay destroys capital. The law artificially revives dead firms rather than moving the entrepreneur to their next venture. In 2005, Congress attempted to reform this system with the BAP-PCPA amendments, but lawmakers focused entirely on accelerating the timeline for rehabilitating the corporate entity, missing the underlying labor dynamic. The authors propose a structural fix: require small businesses to remit payroll taxes simultaneously with issuing paychecks, using third-party software. Neutralizing the personal liability trap removes the primary incentive for inefficient reorganization. Reorganization policy must stop prioritizing the preservation of the firm and start focusing on the efficient matching of human capital to its next productive venture.